Hello, everyone. Tom Smith here from Trade Monster. We're going to get started here in a minute. What I'm going to do is I'm going to put up some disclosures here that are necessary for the webinar. Just go ahead and take a look at these, and once we're through the disclosures, we'll go ahead and we'll get started. Okay, now that we got that out of the way, why don't we go ahead and get started. Chuck, are you with us?
Yes. Can you hear me, Tom?
You sound great, Chuck. Thanks for joining us again this month. For those of you that have already asked questions of us, our moderator, Natalie, can answer any questions you have regarding archives, the playback of this, downloading it. Just put a question in the question and answer section of the chat area, and Natalie, our moderator, will get you that information that you need. Now, there's going to be a lot of questions as of Chuck, but we have very limited time, so we're going to squeeze in as many questions as we can, but Chuck does have a lot of material to cover, so we'll try and do that through the question and answer section. Otherwise, this will be archived at mytrademonster.com. You can check it out tomorrow. It should be up and listed, I would say, by noontime. Otherwise, Chuck, I'm going to go ahead and give you the reins, and let's go ahead and get this party started.
Okay, sounds good. Can you see my slides there?
I'm coming over now. I'm giving you the privileges, so it's going to take one moment. And let's try and share your monitor now.
Okay.
Yeah, here it comes.
Okay, good. I want to put this in slideshow, and we'll be ready to go here.
Perfect.
Okay, great. Thanks, Tom. It's great to be here today, everybody. And Tom, I want to thank you for setting up these educational webinars so that a lot of our fellow traders can benefit. Today I'm going to talk about sector trading, which I've been using for many, many years. And it's a good strategy to allocate part of your portfolio, and it can work in any type of market. And today I'm going to show you trade examples of bullish trades that I have on now, but during the last two bear markets in 2008 and 2001, the sector strategy works just as well in down markets. So we were heavily short during the last two bear markets and did very well with the sector trading. So just keep that in mind. I mean, today we're going to be talking about bullish trades. Okay, so we're going to take a look at trading the strongest market sectors and participating in these sectors using high accuracy ETF option trade selection. And I was just looking at my brokerage accounts today, and I have over $480,000 right now in open trade profits using this sector strategy that we're going to look at today. And I'll show you a few trades that you can take tomorrow. There's actually quite a few buy signals right now as the market has retraced over the last couple weeks, and we'll have a Q&A session at the end, and I'll be glad to answer any questions. So in my personal trading, I trade a portfolio of stocks and stock options, and I also trade ETFs and ETF options in the strongest market sectors, and I select these ETF options using our sector strategy, which we'll go into in detail today. And as I mentioned, one of the best ways to profit in any type of market is to trade sectors, and the goal of the sector strategy is to invest in the strongest sectors with ETFs and ETF options. And just keep in mind, this also works in reverse. We also trade the weakest sectors and take short positions. So in the strongest sectors, we take long positions. In the weakest sectors, we take short positions, and I'll show you shortly how to easily obtain the relative strength for various sectors. A very quick snapshot. It only takes a few seconds to pull it up, and it gives you an instant picture of what the strongest sectors are as well as the weakest sectors. And I wanted to show you, I took these snapshots over many years, and what I'm showing is there's always a bull market and a bear market over the same time period. So what I'm going to be showing you is daily price charts of different markets over the same time period, and you can clearly see that some markets are in bullish mode and some are in bearish mode. Here's an example, the Brazil ETF versus the Internet ETF, and we can see over the same time period that the Brazil shares obviously are in a bear market and the Internet index is in a bull market. Here's the China 25 index and the coffee index. So again, you can see over the same time period, we have a bearish market and a bullish market. This is emerging market Europe versus iShares Italy, the China A shares versus the clean energy portfolio. So you can see that there's always a bull market and a bear market somewhere. The BRIC ETF versus Egypt. And this is during the 2001-2002 bear market, and you can see that the S&P 500 obviously in a bear market, and at the same time the real estate iShares are in a bull market. So there's always a bull market and bear market somewhere. Here's the S&P versus the 10-year Treasury. And this was in 2011. You can see that S&P in a downturn that year in this particular time frame, and the Treasury bonds in a up market. So there's always markets out there to trade. So let's talk about the parameters we use to select sector trades. And first parameter is we want to select a sector with a high relative strength, and we're talking about bullish trades right now, and of course this works in reverse for bearish trades. So we want to select a sector with a high relative strength, and once we identify a sector, then we want to use the Keltner channels to find a low risk entry point to purchase the ETF or the ETF option, and then we use the 1% rule to select an option strike price, and I'll show you examples of these. And what we're always facing is market timing risk when we enter trades, especially option trades, which are leveraged. And this is just a daily price movement of the VIX index, the fear index. And each one of these spikes in the index represents a market sell-off. And you can see there's quite a few of them here. And if you buy an option which is leveraged during any one of these periods where you see a spike up and you have bad timing, of course, buying an option can result in 100% loss if your timing is off. So we want to try to avoid that with the sector strategy. And then once we establish a sector option trade, then we have trade management rules we use. We use the 30% rule for walking away from the trade. We also have a 30% rule for protecting profits, and I'll show you examples of those. And then we also want to roll over trades at option expiration to reduce risk and compound our returns, and I'll show you examples of that. So, and as far as the bearish sector strategy, we want to select a sector that has a low relative strength of 10 or lower. We want to use the Keltner channels to find a low-risk entry point to establish a short position, and we still use the same 1% rule to select an option strike price for a put option. And this strategy, as I mentioned, worked very well during the 2007 through 2009 and the 2001 through 2003 bear market. So we used these sector rules and established short positions during those bear markets and did very well. So let's look at one of the advantages of trading sectors versus individual stocks. And if we trade sectors, we can reduce risk and volatility, as individual stocks can be volatile. And if you have a sector, that sector ETF can help reduce the volatility and risk versus holding individual stocks. And I have a few examples here. This is for Netflix. In the top chart here, we can see this was January 6th. Netflix had a 5.5% decline, and at the same time, the Internet Index, which holds Netflix, actually was up 1.5% for the day. That's the FDN Internet Index. So we can see if you're holding Netflix, 5.5% decline in one day. But if you held that sector, which includes Netflix, you actually would have had a profit on the day. So holding these ETFs reduces that risk and volatility of individual stocks. Here's an example for LinkedIn, down 6.2% versus a 2.1% gain for the Internet Index. LinkedIn is part of this index, so we can see if you held the sector rather than individual stock, you would have had a profit that day instead of a 6% loss. Here's another one. This is Twitter. This is back in February. Twitter was down 24% on the day versus a slight gain for the social media index. So again, holding these sectors reduces the risk and volatility. So let's take a look at how you can get a quick glance on the relative strength of these various sectors so you know which sectors to focus on as far as selecting trades. And I like to use a website. It's called etfscreen.com. And if you log on to that website and you click relative strength trends, then the various sectors will show up, and it'll show you the most recent relative strength for that market. So we can see when I took this snapshot October 10th that JO had a 99.7% relative strength. So it'll list the relative strength in declining order here if you just click this RS trend. And then we can see all the various sectors, and it'll rank them by relative strength. So a handy tool to have, and this is where we start our search for different sectors. Here's a recent snapshot. This is the highest relative strength, and we can see that the top-rated sector had a 99.9% relative strength, and then it goes down from there. So if you look at this screen, you can get a whole list of ETFs with their relative strength. And another thing that I like about this website is it also color codes it. And the darker the green color, the higher the relative strength. And we can see that the dark green here has a high relative strength, and the lighter the shade of green gets, then the lower the relative strength. So here's a snapshot of the lowest relative strength, and what I did is I just went to the bottom of the screen, and you can see these relative strengths are pretty low, 2.8, 2.6, all the way down to 0.1. So, and you can see that these are almost white, and so the color coding also helps too. So you want to look for the green and the dark green. Okay, and let's look at the various components of our sector strategy. And we just saw how we can find out the relative strength of a sector. And I usually like to focus on the sectors that have a relative strength of 90% or higher. And I like to mix it up. In other words, you don't want to concentrate in three or four different financial ETFs. You want to have a tech ETF, financial, maybe a healthcare. So I like to, for diversification, I like to mix it up with the various sectors, but I look for generally the sectors that have a relative strength of 90% or higher. And then the next step is we want to use the Keltner channels to find a low-risk entry. And the Keltner channels are a very helpful tool. This is a chart of the daily price movement of the healthcare index, and symbol XLV. And the top blue line is the upper channel, and the middle dotted line right here is the middle Keltner channel, and then we have the lower Keltner channel, which is this lower blue line. So the Keltner channels act as an overbought, oversold indicator and allow us to get a low-risk entry when we decide we want to take a trade. So the idea of the Keltner channels is when the, in this case, this is the daily price movement of the healthcare ETF, which are these red and black vertical lines, and overlaid on the daily price movement are the Keltner channels. So we don't want to buy when the ETF is overbought, and it's overbought when it's trading near that upper band, and then we want to wait until it drops to the middle or lower band before we take a position. So we can see that right here the ETF is getting overbought as the daily price movement is up above the upper channel. So that's an indication that the ETF is overbought. So what we want to do is wait till it retraces to the middle or lower channel before we buy. And we can see that the healthcare ETFs have a very strong uptrend. And the question is, if you want to participate in this uptrend, where do you jump in? So I use these Keltner channels to help time my entry. And I want to wait until the ETF price retraces towards this middle or lower channel. And we can see if you use this, it's very helpful, because we can see that every time the ETF gets overbought, here's an example here. You can see it's trading up above the upper channel, and it retraces. And then it got oversold, and then rallied again, and then got overbought, retraces, rally. So it follows this pattern pretty well. So idea is we don't want to buy when it's overbought. We want to buy when it's oversold, and that allows for a low-risk entry. And the goal is to enter your position and have very little retracement after you take your position. That way, it reduces your chance of being stopped out. So here's an example. This is for the healthcare index, and my transaction history here says at the end of January, which is right in here, I went ahead and bought the June 45 strike call. So I actually have been buying the healthcare index in increments, and I bought some right here. I bought another position here, and then I added to my position. And this trade, I traded 6 contracts. So you can see, again, on a very strong uptrend, the question is, where do you want to jump in? And I like to trade in increments. So as the healthcare index gets oversold, then I like to add to my position. And you can see that this did allow me to get a low-risk entry because it didn't retrace much from my entry point right here. Here's another example. This is for the ProShares S&P 500 leveraged fund back in April. It retraced towards the lower channel. So I bought the January 65 strike call right here. And again, you can see this is in a strong uptrend, but there are times when it gets oversold, and that allows us to enter this market. So right here, I bought the 65 strike call at 36.21, and then we can see that there was very little retracement after I bought those 65 strike calls. So that's the whole goal of using these Keltner channels. You want to get that low risk entry, and you can see that the market did not retrace after my entry. Here's another one. This is Dow Jones Internet Index. Again, we can see very strong price trend, and I waited till it retraced right here, and this was February 3rd, right here, and when it was oversold, I bought the 45 strike call. So again, that allowed a low-risk entry. Here's one more. This is the biotech index. Again, strong uptrend. Jumped in right here when it was trading near the middle Keltner channel. So in all these examples, the Keltner channels allowed me to get a low-risk entry as the ETF did not retrace much from my entry point, and this helped prevent getting stopped out of my position. So once we decide we're going to buy a call option, then there's hundreds or in some cases even thousands of strike prices to choose from. So the question is, which strike price do you choose when you have all these choices? So selecting that strike price can be just as important as selecting the trade itself. So we use what I call the 1% rule to select the option strike price. And option premiums consist of time value and intrinsic value. And at expiration, options lose all their time value. So when you buy an option, you're buying a decaying asset. And each day, that time value portion of the option decays a little further until you get to expiration, and then the time value goes to zero. So you always want to keep that in mind when you're buying options. So due to the time decay characteristics, we want to, when we buy an option, we want to minimize the time value and maximize the intrinsic value. And the way I do that is I like to limit the time value portion of an option to less than 1% of the stock price per month. And if you do that, that will minimize the time value and maximize the intrinsic value. So, for example, if you purchase a 1-month option on a stock that's trading at 100, you want to limit the time value portion of that option to 1 point or less. So that's 1% per month. And if you purchase a 2-month option and the stock is trading at 100, then you want to limit the time value to less than 2 points, which would be 1% per month. So the goal is limit the time value to 1% per month. So if we do that, then the underlying ETF only needs to increase 1% in order for the trade to break even. So if the underlying ETF only has to go up 1%, that obviously is going to have a much higher probability of being profitable than an option strike price that requires, let's say, a 10 to 15% increase in the underlying ETF to break even. So the goal is we want to have a profit with just a small increase in the underlying ETF price. So here's an example. My brokerage confirmation shows I bought the January 65 call at 36.21, and at the time SSO was trading at 146. So if I put in the current stock price, and in this case I bought the 65 strike call, put the option strike price in there, and the premium we paid, and click calculate, it'll calculate the profit potential for this trade, assuming various price changes in the ETF at option expiration, in this example from a 30% increase to a 10% decrease. And it'll also calculate the time value portion and intrinsic value portion of the option. So with an option premium of 36.21, when I bought this option, this was back April 11th, this premium only had 75 cents of time value, so it had very little time value compared to the intrinsic value. So in this case, I was minimizing that time value and maximizing the intrinsic value. So the bottom line is this SSO, I bought this as in April, this is a January 2015, so this had about 9 months to expiration. So over that 9-month time frame, if the SSO increases just 75 cents, then this trade will break even and I'll start making money. So that's why I like to use that 1% rule. In this example, the SSO, which is the leveraged S&P 500 index, with only 75 cents of time value, the SSO only has to increase 75 cents or 0.7% for this trade to break even, and then I start making money. So any increase above that 75 cents will result in a profit. And if you look at the current at-the-money call for SSO, it requires 14.7% up move in the ETF just to break even. So the in-the-money call purchases obviously have a much higher probability of success than the at-the-money or out-of-the-money strike prices. So if you look at the current at-the-money for SSO, it has to move up 14% before you even break even. So I'd much rather have it a low time value where it only has to go up 75 cents or 0.7% versus a 14% up move. So this really reduces your risk when you're trading options. And another thing to keep in mind, if you buy an at-the-money or an out-of-the-money call, you're looking at 100% loss if the underlying ETF is flat or down slightly at option expiration. So you always want to keep that in mind when you're trading options, is you want to get an in-the-money call that's less leveraged, because if you get an at-the-money or out-of-the-money and the ETF is flat or even down slightly, then you're going to lose 100% of your investment. So you always want to keep that in mind. So let's look at some.
I'm sorry, Chuck, that's just the rule of thumb for you. I don't want to interrupt, but we are getting, Chris Maggio's asking, the strategy is to always buy in deep into money options then?
Yes, yeah, that's always the strategy, because you'll have a much higher probability of success with the in-the-money options. versus at the money or out of the money. Now let's take a look at some of my current positions, and we've had a recent down move, so this is a more recent relative strength rating here, and I just wanted to show you my current ETF positions, and these are actually buys right now because of the recent market decline. But one of the ones I have is the TQQQ. That's the triple Qs. That's a leveraged fund for the NASDAQ. We can see has relative strength of 98, and you can see this is over the past year. It's had a very high relative strength around 98, 99. So, and you can see the dark green color goes across the whole screen on this one. So this is a really, really strong one. I've owned this for some time. Here's the XLV, the healthcare index. That's at 94%. And again, that's been green over the past year, so high relative strength. I also own the UPRO, which is the leveraged S&P 500 index, and we can see even that's been in the 90% relative strength range over the past year. So I like to mix it up and invest in different sectors. And here's the QQQ. That's the NASDAQ fund that's not leveraged, and we can see right now that has a relative strength of 91%. And I also have the FAS, which is the leveraged financial ETF. So I have a different combination: healthcare, financial, tech, S&P 500. I like to diversify into different sectors that have high relative strength. So let's look at some examples. XLV, 94% relative strength, and this just shows my I own 48 contracts of the January 45 call, and I use the Keltner channels to leg into my position. Bought some here, bought some here, bought some here, and the Keltner channels helped me find a low-risk entry for the XLV. And just going over the trade selection here for XLV, it has a high relative strength, current relative strength of 94. I use the Keltner channels to find a low-risk entry point. And when the XLV was trading near the lower channel, I entered the trades, the various trades, the increments. And the important thing is the XLV did not retrace much from my entry point, so it allowed a low-risk entry. And then I used the 1% rule to select an option strike price. And XLV only had to go up 1% in order for me to break even and start making money on my trade. Here's another example. This is for the the leveraged financial fund, and we can see that's had a high relative strength over the past year. Right now it's at 90.2%. And I own 60 of the January 50 calls, and I bought them in this time period here when the ETF traded near this lower Keltner channel, got oversold, and that allowed a good entry price. Here's one more. This is for the triple Qs, and entered this in increments also, some early in January of this year, and then more in April and May when it retraced further. So I legged into the triple Q trades. I own 60 of the January 40 strike calls, and again used the Keltner channels to find my entry point and the 1% rule to select the option strike price. So once we put on an ETF sector trade, then we have rules for managing that trade. So let's take a look at the option trade management rules for our various ETF sectors. And whenever we buy a call option, we use what I call the 30% rule for walking away from the trade. We also have a 30% rule for protecting profits. And then we also like to roll over trades to reduce the risk and compound returns. And I'll show you examples of these trade management rules that we use once we establish the position. So once we find a sector that has a high relative strength, we find a good entry point with the Keltner channels, and then we use the 1% rule for selecting the strike price. Then we want to use the option trade management rules to manage that trade. And let's take a look at the first rule here, which is the 30% rule from walking away. And if you purchase an ETF option and the price drops 20% below your entry price, you want to start monitoring that position. And then if the price drops 30% from your purchase price, then you simply want to exit the trade. You had bad timing, you were wrong for whatever reason. So we want to start looking, and I usually look at my positions once a day. I don't follow them very closely, but if I see that the price of an option is starting to drop, if it gets around 20% below my entry price, then I start monitoring it, and then if it hits 30%, then I simply want to exit the trade. So you want to do that because that'll help prevent a 100% loss. So you don't ever want to incur a 100% loss. So we use this money management rule for exiting the trade if we have a 30% loss, and then you can live to trade another day. Whereas if you take a 100% loss, it's tough to really make up for that. So goal is not to have any 100% losers, and we simply exit when we have a 30% loss on a trade. And of course, options are leveraged compared to just buying the ETF, so that's why we give them a little more room, and we simply want to exit the trade if we're wrong. So here's an example. Bought the SSO S&P 500 Index ETF. I bought the January 65 calls at 36.21. So if the price of this option that I bought at 36, if that gets down to around 29, then I'm going to start, which is a 20% loss, then I want to start monitoring this position. And if it drops 30% to around 25.30, then I simply want to exit the trade and prevent that 100% loss possibility. So simple money management rule to exit the trade before it develops into 100% loss. And we also have a 30% rule for protecting profits. And if we have a 30% profit in an option trade, then we want to create either a debit spread or a market neutral strangle to help protect those profits. So that's a big part of the money management is whenever you have a 30% or higher open trade profit, then you want to look at creating either a debit spread or a market neutral strangle. And what that does is it helps protect your profits. So we'll look at the debit spreads first, and these debit spreads can profit if the underlying stock or ETF is up, flat, or even down at expiration. So if we have a 30% profit in a call option, then we want to look at selling a call option with a higher strike price, and I'll show you an example of that. So again, if we have a 30% profit in a call option, then we want to sell a higher strike call option to help protect the profits in that trade. And The call option that we purchased profits, of course, if the price of the underlying ETF increases, and the call option that we sell profits as the price of the underlying ETF decreases. So you have, with these spreads, you have both a bullish position and you have a bearish position. And with these debit spreads, your risk is limited to the cost of the spread. So when you create a debit spread, it increases the profit potential of your existing option purchase, and at the same time, it also provides downside protection in the event the underlying ETF or stock goes down in price. So two things happen when you create these spreads. You increase the profit potential, and you also provide downside protection. So let's look at an example. My brokerage profit loss report here shows that I bought 60 of the triple Qs, that's the leveraged NASDAQ fund. The January 40 calls, I bought those at $25.80. So bought 60 of the January 40 calls, $25.80, and I had a profit in that. So I went ahead and sold to open 60 of the January 65 calls at $10.85. So had a 30% profit. Then I went ahead and sold 60 of the January 65 calls. This created a debit spread, and good things happen when you do that. It increased the profit potential of my existing option purchase, of the 40 strike option purchase, and at the same time provided downside protection. So what I did is I plugged in, bought the 40 strike call at $25.80, sold the 65 strike call at $10.85. So that created a debit spread, and I plugged those into the call option spread analysis, and this will calculate the profit potential for this trade, assuming various price changes in the triple Qs. In this example, from a 20% increase in price to a 20% decrease in price. And this bottom row here is the percent return based on the various changes in the triple Q at option expiration. So we can see if the triple Qs are up 20%, I get a 67% return. If the triple Qs are flat, I get a 67% return. And if the triple Qs drop 20%, I still get a 67% return. So during the recent sell-off, I was able to hold my positions because I had this downside protection because I was short the 65 call. So this is a good way to profit in any kind of market, and I didn't really have to watch my spread positions much. And they didn't go down as much as compared to, let's say, if you just owned a call option in the triple Qs during this recent decline. You could have been stopped out of your call option, but with this debit spread, when I sold that 65 call, and that profits as the price of the triple Qs go down, I created that downside protection, so I really didn't have to worry about the sell-off because I knew I had that downside protection in place. So again, the option that I purchased, the 40 strike call, that profits as the price of the ETF increases. The 65 strike call that I sold, that profits as the price of the ETF decreases. And again, my risk was limited to the cost of the spread. And when I sold that 65 strike call for $10.85, that almost doubled the existing profit potential of the 40 strike purchase. So when I sold that 65 strike call at $10.85, cash went into my brokerage account. So I sold the 65 strike call at $10.85, So I received $1,085 in cash per contract for a total of $65,000 in cash that was credited to my brokerage account as soon as I sold that 65 strike call. So that was my downside protection right there. And it also almost doubled the existing profit potential. So I increased my profit potential. I got $65,000 worth of downside protection, and I reduced my overall risk. I paid $25.80 for the 40 strike call, so I reduced my overall risk from $25.80, $2,580 to $1,495 when I sold this 65 strike call. So you can see a lot of good things happen when you create these spreads. And again, I was able to hold that position during the recent correction when the NASDAQ dropped about 10%, and the spread helped me avoid being stopped out of my 40 strike call purchase. And here, this is an interesting snapshot. I took this, and at the time, this was a day when the NASDAQ was down 1.6%, 66%. So that's a pretty big drop in the NASDAQ. The Dow was only down, 85 points, but NASDAQ down 1.66. And I took this snapshot. This was of my portfolio positions at the time, and I had these were all spread positions. So I had both stocks and option spreads. And on a day when risk was off and the NASDAQ was down 1.66%, this is a list of all my positions. I actually had a slight profit on the day of $397. So on a big risk-off day with these various spreads, I actually had a slight profit for the day. So there's less volatility in your trading account when you trade these spreads because you have those short positions, both for your stock positions and your option positions. So I thought this was kind of interesting on a big down day that I had a slight profit. So that shows the advantage of holding these spread trades. And we also like to create market neutral strangles also as a spread trade when we have a 30% profit. And so there's two types of spreads we create whenever we have a 30% or higher profit. We want to create a debit spread, which I just showed you, or a market neutral strangle. And typically, I like to create these debit spreads on stocks that have rich option premiums because you're selling the premium. And then the options that have lower volatility, I'll establish a market neutral strangle, and I'll show you an example of that. And with the market neutral strangles, we buy a call option, and then we buy a put option to protect the call option. And of course, the call option we purchase, that profits if the price of the underlying stock increases, and the put option profits as the price of the underlying stock or ETF decreases. Your risk is always limited to the cost of the spread, and with the market neutral strangles, there's no limit on the profit potential of the spread if the underlying stock or ETF continues to increase in price. So let's look at an example of a market neutral strangle. This is for the NASDAQ ETF, the triple Qs. I used the sector strategy to select a call option purchase, and I used the 1% rule for selecting the option strike price. So I had a 30% profit in these in the triple Qs, and I went ahead and created a market neutral strangle. So my brokerage account profit loss report shows that I bought the triple Qs the January 80 call at 861, and then to protect that profit, I have a nice profit in it. To protect that profit, I bought the October 93 puts, which expired last Friday. So when these expired, then I purchased the January puts, and that'll protect me till the January calls expire. So I like to buy the longer-term call option, and then every 3 months or so I'll sell, or I'll buy a put option to protect my profit. So in this example, bought the 14 of the January 80 calls at 861 and bought 14 of the October 93 puts at 165. And I have a market neutral calculator that will calculate the profit potential for this trade based on various price changes in the triple Qs at option expiration, in this example from a 30% increase to a 30% decline. So in this bottom row here is the percent return. So we can see by buying that 93 strike put that I can't lose money with this trade. In other words, I locked in a profit no matter what the underlying QQQ does. So if it goes up 10%, I'll have 184% return on this spread. If the triple Qs are flat, then I'll have an 87% return. And if they go down 30%, I'll have 129% return. So the buying that put option protection actually locked in a profit no matter what the QQQs do. So one of the advantages of this market neutral strangle is the profit potential is not capped. And as the ETF moves up in price, then my profit increases. So we can see if it's flat, I get 87% return. If it goes up 10%, I get 184% return. If it goes up 20%, I get a 280% return. So your return potential is not capped with these market neutral strangles. So as the price moves up, your profit potential keeps increases. And again, if it's flat at option expiration, then I get an 87% return. And one of the nice things about these trades is once you put the trade on, you can just forget about it. You don't have to worry about protective stops or big down moves in the market. And as I showed you before, that portfolio snapshot that day that the NASDAQ was down 1.6%, you could see that my combination of debit spreads and market neutral strangles actually had a profit on the day. So this really reduces the volatility in your trading account when you use these spread trades. And one last thing is the rolling over the options. And if an ETF still has a high relative strength and the trade is profitable, then we normally roll over the option at expiration. And if you roll over the options, that reduces your risk and allows you to compound your returns. And here's an example of XLV June 45 calls. I sold those and rolled into the September calls. So this column right here shows the profits I had on the various quantities here. This was filled in increments. So this first increment of 16 contracts had a $22,700 profit. So I closed out the June options and bought the September options. So when I closed out the June options, I had total profits after commission of $31,501. So closing out the June options, I had a $31,000 profit, and then the cost of the September options were $56,000. So when I rolled over, it reduced my total risk from $56,500 to $25,000. So that more than allowed me to reduce my risk by more than 50%. And then, of course, that allowed me to compound returns. So, again, rolling over the option reduces your overall risk because you're rolling over your profits and allows you to compound your returns. So we normally roll over if the sector still has a high relative strength, and we'll go ahead and roll over at option expiration. So,
Chuck, as a norm, would you roll over into the front month, or would you go out further?
No, that's a good question. In this case, I rolled over 3 months out, so closed out to June and rolled into the September. So in this example, I rolled out three months into the future. So I normally don't do it monthly, but I'll roll over 2 months out, 3 months out, 4 months out when I roll over. Okay, so that concludes my presentation. I'll be glad to take any questions.